When browsing what to invest into, you might have come across money market funds and wondered exactly what they are and when you might consider investing into one. Or maybe this is your first time hearing about them altogether. Either way, I'm going to break down exactly how to invest into a money market fund in this video. And just to let you know, this isn't financial advice and your capital is at risk when investing. A money market fund is an investment that is generally considered to have a lower risk, lower reward approach when compared to the stock market. Money market funds, or MMFs for short, typically invest into things that are considered to be safe, like treasury bills and commercial paper, and often focus on investments with short dates to maturity. What we mean by this is, in the case of a government bond, there isn't long left until the bond is paid back. These funds aim to offer a safer place for investors to park their cash with minimal risk while earning a small return, usually in the form of interest. That isn't to say that there are no risks whatsoever, there definitely are risks, and I recommend looking up when money market funds broke the buck in the 2008 financial crisis. I'll leave a link in the description below. So there are risks, they're just considered to be safer investments to make compared to, say, the stock market, property, and other things like that. The downside to this added security is the lower yield of returns, with most money market funds only returning a little more than an easy access savings account or cash ISA you could get with your bank. The returns you'll get from a money market fund are also heavily affected by the current interest rates from the Bank of England. So in recent years, when interest rates were at an all-time low, money market funds weren't offering high returns at all. But in the last few years, they have managed to climb back up. But the real benefit of investing into money market funds is their shorter term nature and how liquid they are. They pay interest and you're usually free to take your money out at any time. This results in them being a way for people to park their money for the short term whilst gaining some returns on it instead of just letting it sit in a current account. For example, people might put their money into a money market fund when they have spare cash and haven't decided where they want to invest it yet. Some people also use money market funds as a way to diversify their portfolio and have a lump sum of cash ready to access should they need to pay off loans for any emergencies they might encounter. Think of them being a little more like a savings account than a stock market investment, though the risks of the stock market still apply, as you're not protected if an MMF goes under. Now you might be thinking, why wouldn't I just put my money into a fixed rate savings account? Well, you can do that, but the recent raising of interest rates highlighted a benefit of money market funds over savings accounts. You'll typically find that money market funds reflect changes in interest rates quicker. They grew in popularity recently because as central banks across the world hiked interest rates, many banks were slow to reflect these increases, keen to make a profit on the difference between what the central bank offered and what they gave to clients. Banks actually use MMFs themselves to generate some returns, offering customers a lower rate and skimming the difference, which is a massive difference in many cases. Money market funds tracked the central bank rate much more closely, giving users direct access to those higher rates, albeit with a little less protection. So now you know what money market funds do and when people are likely to invest into them, let's look at how you would actually invest into them yourself if you wanted to do so. And I just want to remind you that in no way am I advising that you invest into money market funds. I'm simply explaining them to you so you can make more informed decisions with your own money. I am not a financial advisor and this is not financial advice. Unlike with ETFs and index funds, not every broker will offer a wide range of money market funds. So be sure to check whether your platform does offer them before you open an account if this is something that you want to invest into. For this example, I'll use InvestEngine to show you a money market fund that you could potentially invest into. There are other brokers that you can use, so this isn't a recommendation, but it's easier to show you with an actual example rather than just explaining it. On InvestEngine, you need to click the ETF range tab and then scroll to Collections. Then under Collections, you should see Money Market Funds. Here you'll see multiple different options, so you can click into each one to research them further. We'll just take the top result for our example, the Lixer Smart Overnight Return, which has generated a 5.47% return over the last 12 months at the time of recording. You can also see the ongoing charge, or TER, which you'll have with every fund you invest into. And this is usually quite low with money market funds, but can be as high as 0.25% a year in some cases. So check to make sure you're happy with this charge before you invest. The fee for our example MMF is 0.1%. So it's on the lower end of fees charged by the fund managers, especially considering it's an actively managed fund. InvestEngine have also told us that 8% of their users invest into this MMF, again at the time of recording the video. It's an accumulating fund, meaning that dividends are automatically reinvested back into it, but I'm not going to explain exactly what this fund does. You should always do your own research before investing and speak with a professional financial advisor if needed. For information on risk and other details, click the Key Investor Information link. You'll see here that this is rated as a 1 out of 7 in terms of risk, which is very low compared to an S&P 500 ETF, for example, which is rated 6 out of 7. There still is some risk to MMFs, but maybe we'll do a separate video on that, so let us know in the comments if you'd be interested in seeing that. To invest in the Lixer Smart Overnight Return MMF, simply click the Invest Now button at the top of the page and choose to add a lump sum for a one-off investment of at least £100 or an ongoing savings plan of at least £50 per month. One thing to note is the tax that you could incur when investing into one of these. If you're not investing inside a stocks and shares ISA or similar tax efficient account, you will be susceptible to tax, so do be wary of that before you invest. They are taxed in the same way as other investment income, and returns from MMFs are classed as income from interest rather than dividends, so be sure to invest inside a stocks and shares ISA to avoid this. And that's all there is to it. Now you know what a money market fund is, what it does, and how you can invest into one yourself. If you're looking for a different broker to use and aren't sure who to choose, you can gain access to our free cheat sheet in the description. You'll get an overview of all the top brokers and funds with a breakdown of each of them. And if you want a detailed walkthrough for using Invest Engine, the example broker we used today, you can watch the video that I've left on screen for you now.